Hello, and welcome to this week's edition of Checks and Balances TV. I'm your host, Matthew J. Rettick, and I'm committed to giving you the truth you need to financially succeed. Each week, we'll review the news, check the facts, and provide balanced insight and unbiased advice to help you make critical financial decisions. So let's get up, get energized, and get going and see how today's headlines impact your financial future. Wall Street saw another record year in 2010, taking in more than $21.4 billion in investment banking and trading revenue in just the first 3 quarters. While the final numbers for 2010 will likely fall short of 2009's record of $61.4 billion, much of that was fueled by federal assistance. The 5 largest U.S. banking firms, being Goldman Sachs, J.P. Morgan Chase, Bank of America, Citigroup, and Morgan Stanley, took in more than $93.7 billion in total revenue. Income sources came from its trading activities, advisory and underwriting fees, and other related ventures over the first 3 quarters of 2010. Although these figures are about 10% less than the same 3 quarters of 2009, these Wall Street banks will cash in a record 2 years of revenue. Wall Street bonuses are expected next month, and the projected numbers are still staggering. According to the New York State Comptroller's Office, cash bonuses to securities industry employees in New York City grew 17% to $20.3 billion for work performed in 2009. It's projected that while the cash bonus amounts will likely be a smaller total, the average bonus per person may actually be bigger. Due to job losses, the anticipated bonus money will be divided among fewer employees. Okay, so what's really going on here? Let's check the facts using our checks and balances process. Despite the staggering U.S. economy, Wall Street is still on top financially. The surge of record-breaking revenue comes after the Treasury Department's Troubled Asset Relief Program, also known as TARP, to purchase assets and equity from troubled financial institutions. The Treasury Department first started laying the groundwork for TARP in September of 2008 after the investment giant Lehman Brothers collapsed. The top 5 banks took a combined total of $135 billion from TARP and borrowed billions more from the Federal Reserve's emergency lending facilities in 2009. It was speculated at the time that if these banks were allowed to fail, so would the American economy. Wall Street had a $43 billion loss in 2008 and then rebounded to a $61.4 billion profit in 2009. Revenue at many Wall Street banks is comprised of fees associated with advisory services, debt and equity underwriting, and from trading stocks and bonds. The buy side of Wall Street is comprised of investing institutions such as mutual funds, pension funds, and insurance firms that tend to buy large portions of securities for money management platforms. The sell side includes providing research and recommendations on stocks to the buying public. Together, the buy side and sell side make up both sides of Wall Street. Fees now are charged when banking, investing, executing a trade, receiving advice, and a few more revenue sources. Wall Street bonuses are a sore spot for most Americans. Despite the weak U.S. economy, the average bonus for 2010 may be larger than last year's. Bonuses jumped to more than $20 billion in 2009, with the average bonus on Wall Street at $123,850. While the cash bonus pool for 2010 will most likely be smaller, the average bonus may be bigger since there are fewer employees to divide the money between. The industry employed 160,200 people as of September 2010, down from a peak of 200,300 in December of 2000. Among the largest banks, only 2 have taken measures to reduce executive bonus compensation because of public backlash. Morgan Stanley recently told their employees to expect investment banking bonuses to decline 10% to 30% this year. However, at other banks, top executives are preparing to receive record-setting bonuses. The CEO of J.P. Morgan Chase will receive about $6.8 million this month, and the executives at Goldman Sachs, a firm that took close to $10 billion in federal bailout money, will be paying $111 million in stock to its top executives this month as part of its delayed bonus money for previous year's performances. More than 70% of Americans say big bonuses should be banned this year for those Wall Street firms that took taxpayer bailout money. However, according to a recent survey conducted by the Wall Street Journal, about 36 of the top publicly held securities and investment services firms are set to pay out $144 billion in compensation and bonuses this year, a 4% increase from the $139 billion paid out in 2009. Okay, so you may be asking yourself, well, Matt, what does all this mean to me? Well, now that we've checked the facts, let's balance this news using our checks and balances process to determine what action you should take today. We obviously need our banks to be healthy and profitable. They are the foundation of a great economy. But as consumers and Americans, we also need to be able to save, borrow, and invest to prosper. However, our banking industry appears to have been exceedingly greedy in recent years, taking and charging more while lending and giving less. And Wall Street has benefited from low interest rate environments recently and some of the Fed's purchases of securities through TARP. Due to these unique economic conditions, most analysts agree that these record-breaking profit levels are not sustainable. Another important goal of TARP was to encourage banks to resume lending again at levels seen before the economic meltdown of 2008. And lending in 2010 was up by 17%, according to the Small Business Administration, who attribute this increase not to TARP, but to the Small Business Jobs Act passed last year. SBA officials say there is some doubt that the uptick in lending will continue in 2011. Why? Because the incentives to lend were only good through the end of 2010. Bonuses are a part of a Wall Street employee's total compensation package and are based on individual job performance for the year and the prospects for new business in the future. The average securities industry wage in New York City has fallen more than 20% in the last few years to, get ready for this, $311,000 per year. Now, keep in mind the cost of living in New York City is more than double compared to most other American cities. But that annual income is still higher than the average wage earner for other private sector jobs in New York City. In fact, the securities industry is so well paid in New York that the state attributes 15% of its annual tax revenue to what is collected from Wall Street companies and its workers. The state even said if Wall Street bonuses fall, their budget deficit will rise. My, oh my, what a mess we're in. Okay, so what's the bottom line here? To start with, quit paying Wall Street banks such high fees. Without those fees, they wouldn't be breaking records of revenue. Also, work to become a 21st century investor. That's one who pays wholesale, not retail, in sales charges and fees when investing your hard-earned money. Also, work with a true, comprehensive financial advisor who can offer more than just stocks or mutual funds or insurance products. Look for an advisor that is not motivated by the amount of fees you pay their firm, but by the results they can provide you. You also want someone who has access to the entire universe of financial products and who can make recommendations based on your unique needs and goals and not what's in their best interest or their firm's. In this week's CBTV poll, we asked Americans an important question. What is it about Wall Street banks that has you most upset? The options were A, the hidden fees, B, big bonuses for employees, C, one-sided recommendations, D, receiving federal bailout money, and E, nothing, I'm happy with my Wall Street banker. Well, 67% of you said receiving those big bonuses this year has you the most upset, and understandably so. Many of these companies received a huge bailout and now plan on paying their employees and themselves a big bonus. Wouldn't it make more sense if a bonus was paid only for a job well done and not as a payoff to keep employees at a firm? I believe the average hardworking American would certainly agree with me. In our On the Street segment, we travel the country to ask Americans what they think about an important financial topic or issue. For this week's segment, we asked people if they received their bailout checks from the government and their opinions on Wall Street firms. Let's take a look at what America had to say. The government sent out $700 billion in the bank bailout. Did you get your check?
No.
I didn't get a check either.
No. I get my check from my business.
That's right. You know, in the last 2 years, the government sent out over $1.5 trillion in an economic bailout stimulus package and a bailout for the banks and the financial institutions. I just had a question. Did you get your check?
No.
You didn't get a check?
Nope.
I didn't get a check either.
No?
Where'd all that money go?
Not quite sure.
I figured out that at Checks and Balances that if they'd taken that $1.5 trillion and given it to every adult in America, came out to about $100,000 each.
I think that would stimulate the economy.
Well, yeah, there you go. That's what I was talking about.
I'll do my part in stimulating the economy.
Between the economic stimulus package and the bailout program, sent out $1.5 trillion in the last 2 years. $1.5 trillion. Did you get your bailout check?
No, not a penny. No. Is there such a program? Because I didn't get it.
The last couple of years, the government has sent out a total of $1.5 trillion, not billion, $1.5 trillion in this economic stimulus plan, this bailout program. Did you happen to get your check?
No, I did not.
I didn't either.
No.
Do you think other Americans got a check?
No, I don't think they did either, no.
What might have been some better ideas to do with that money?
I think instead of doing a bailout, government bailout, they should just send every homeowner a check so that homeowners could bail themselves out of their own debts.
That's a fabulous idea, Anthony. No, it doesn't look like anyone is bailing out regular Americans. If the government had, I bet that most Americans would have put that money right back into the economy, and we would be on our way to recovery a lot faster than we are today. And now for Matt's weekly tip, tool, or technique. Become a 21st century investor this year. A 21st century investor is an individual who is informed and educated on the best ways to grow, protect, and preserve their financial nest egg now and in the future. This new economic environment we find ourselves in today requires each of us to become the master of our own financial fate. A 21st century investor utilizes the best advice in investing and savings vehicles to help them defer or eliminate taxes, reduce or avoid fees, protect and grow their money, and create an ongoing income that will maintain their desired lifestyle throughout retirement. A 21st century investor also realizes that they cannot go it alone, and they formed a new level of relationship with a true, comprehensive financial advisor. And together they take a much more active role in managing all phases of their financial future, including insurance, investments, taxes, estate and legacy planning. Work to become a 21st century investor in 2011. And here's a tip to help you get started. If you like to buy mutual funds, be sure to buy mutual funds that have the lowest fees possible. The most common mutual funds today are A share, B share, and C share, and each have a different way in which fees are charged. Some are upfront when you invest your money. Some are annually. Some are deducted when you take money out of the account in the first few years, and some are a combination of these. However, there are also no-load mutual funds that have no sales charges or upfront fees whatsoever. So make sure you purchase the right mutual fund for you. Now is the time to realize that neither Wall Street banks nor the government are responsible for the success of your investments and overall financial plan. You are. And since there are no bailouts for your retirement, work hard to become a 21st century investor and keep more of your hard-earned money from going to unnecessary fees and taxes. Mark your calendars for the next installment of our Truth About series. This upcoming episode will air later this month and is on the truth about mutual funds. You will learn the pros and cons, both sides of the coin, on this important financial product, so you'll know if it's the right investment for you. And also be sure to friend our Facebook page and subscribe to our YouTube channel to gain exclusive access to our library of viral videos and the lighter side of finance. For more information on how to become a Checks and Balances savvy consumer and to download any of our free reports, visit the download section of our website. Also, be sure to get your free copy of The 3 Pillars of the Checks and Balances Life, a report that gives you a guide for truth and accountability in today's challenging financial world. And while you're on the site, remember, your voice counts. Be sure to take this week's poll and visit our Tell Us What You Think section to share your opinion. Make your voice heard. And finally, remember that only you can control your financial future. You can succeed. You just need confidence and determination. I'm Matthew J. Rettick from Checks and Balances TV. Be sure to join us next week when we'll discuss getting out of debt now. Until then, spend less, save more, believe in yourself, and make it happen.